You come out of the Fed meeting, you see that drop down in yields, that bid in the bond market. And is it a believable move downward here? Do you think that there's still more upward pressure to come?
I don't think there's a lot more upward pressure to come. I do think that typically on Fed Day, the market gets optimistic. I think Powell, Chairman Powell does put information out there that makes people, react positively. Our base view is this whole notion of kind of a higher resting heart rate for inflation. We've talked about that for some time. That's still where we are. We actually don't have any Fed cuts in our forecast this year, but we do have the 10-year starting to come down a little bit by year end.
How do you feel about when the Fed actually does cut? If you believe that they can't get anything done this year, why is that, given the market is still expecting at least one in December?
Yeah, I think let's talk about the short end and the long end. So on the short end, this cycle has been very different, that it's taken longer for the Fed increases to actually impact the economy. What happened? Consumers, 2006, they had about 30% of their mortgages in variable rate. Today, that number is 3%. More people have kept their jobs during the Fed tightening cycle. So there's a different backdrop. We've talked about fiscal impulse. We've talked about geopolitics, energy transition. All those things have led to kind of this higher resting heart rate for inflation. So I think the market, sometimes wants to get ahead and say, oh, this is a classic Fed easing cycle. That's not the way we see it. The long end, I do think you have to take some comfort in yesterday's announcement that they're going to start to taper, which is, we have the Fed's balance sheet going down to about 6.8 trillion and then pausing there on the taper. But that's still a huge number. It's probably 35 to 40% of GDP. I mean, when I started in the business, it was 2% of GDP. So there's a huge change. That's actually still very accommodative. So my bottom line is, when you look at the short end on a real rate basis, which is what matters after inflation, this isn't that restrictive. And then when you look at it on the long end, the Fed is still protecting you a bunch with the liquidity that's providing in the system. The offset to that is that people are keeping their jobs, and they did a really good job of kind of extending the duration of their mortgages and other pieces of credit. So I think we continue, our mantra for this year is kind of glass half full. No doubt there's lots of cross currents, but we tend to think that the market's going to continue to do okay.
How does that set you up for jobs? On one hand, do you have optimism around tomorrow's report, and where does it stand relative to where you see the rest of the year going? Because realistically, there's a lot of uncertainty around how hard we land here, or how soft we land.
I'll tell you what we're good at and what we're not. I mean, KKR, most of our capital is kind of 5 to 7 year duration. We've been focusing on the structural changes in the job market, and let me tell you what I think there. One is 55 year and older professionals are actually retiring at a record clip. That's putting pressure to keep the unemployment rate lower. The offset of that is, when you look on Friday, what would I focus on? Let's focus on the 3 structural areas that are growing. 1 is the government, 2 is healthcare and education, and 3 is travel and leisure. Structurally, they're below trend, and they've actually accounted for, depending on the month, somewhere between 75% and 100% of all the job growth. And people don't pay much attention to that, but you really haven't had a lot of growth outside those sectors. So if there was really a problem in those 3 areas, I probably would have more nervousness, but that's not my base case. And by the way, the Thursday jobless claims was 208,000, which is really, really low. So I know that we're worried about not as many jobs being added, but when you look at the unemployment claims, Thursday's every Thursday we see that data, we're still at very healthy levels.
You started this conversation talking about a higher resting heart rate for inflation. You had a report recently speaking with CIOs across the country here about, in the insurance sector in particular, looking at a regime change.
Yeah.
These are some of the largest fixed income investors in the world looking at what you're saying, potentially higher for longer, maybe higher forever, inflation. Put that into perspective.
So I think the insurance market is hugely important to KKR. We actually own our own insurance company, Global Atlantic. But more importantly, we partner with a lot of our clients. And so what we did with the surveys, we surveyed about $8 trillion of assets around the world. And what you see is a couple things. One is, most of the CIOs agree with us that there is this regime change, and driven by this higher resting heart rate for inflation. What's most interesting about the report that's out is that when rates went to 0, last time we did the survey, there was 15 trillion in negative interest rates. Today, that's 0. They were about 31% non-traditional assets. So they were looking for ways to find yield, to find diversification, to find return. Even though the Fed's raised rates 21 times, that percentage has barely come off. And so what it tells us is they've had a really good experience using alternatives and other forms of kind of non-traditional stocks and bonds, but they're preparing to create kind of all-weather portfolios. The number of times that a CIO told us, we want to find something that can actually ride out the storm. We've seen extraordinarily low rates. Now you have very high rates, and I think they're ready for that volatility, but it's led to a dramatic kind of repositioning of the portfolios.
I can make a lot of insurance jokes about all weather right now, but I will refrain from that. What do you think about the divergence here between what you're seeing from your clients on the expectations for inflation and interest rates versus what the Fed is saying?
Yeah, look, I think the Fed, where we've probably differed over time is, starting with the transitory. I mean, we own kind of, depending on the day, 150 to 200 companies. We get pretty good real-time data. And the area where we've continued to see sticky inflation has been around services. So Chairman Powell talked about that he doesn't see the stag or the inflation. I think on the stag, we would agree. And what we would say is productivity is actually quite strong. Companies invested a lot around their kind of their infrastructure to make it more efficient when COVID hit, and we're now seeing the productivity gains there. Where we might disagree, though, more is around this inflation comment, and we do see that. We see that in wages. You think about medical costs, insurance costs. I mean, one of the great things about partnering with insurance companies is when you have inflation going up or down quickly, they see it. They see what it costs to repair a glass pane. They see what it costs to fix a bumper, and so what I would take away from them is the survey is they're probably in the same spot we are, which is our businesses are saying, yes, there's inflation coming down, but probably hitting the 2% target is going to be quite hard. I thought one of the, well, go ahead.
Yeah, if that's going to be so hard, does the Fed have room to raise rates if they needed to? And do you think that it's something we could see?
That's not our base view. I think that the Fed's done a great job of kind of where they are, getting rates up quickly, moving aggressively, and starting to do the taper. I think one of the new kind of nuggets that we took away that was a positive yesterday is I think Chairman Powell did introduce the notion that under 3% inflation, you get a little more emphasis on the dual mandate of employment and not just inflation, right? Remember in Europe, it's 100% inflation, no kind of growth and employment mandate. So I think they've done a good job. I just think it will take out a little bit longer to play out.
So let's talk about something else, because you recently came back from China, and the other big question mark that is sitting over the market is geopolitical risk and the relationship between the U.S., China, and the rest of the world in what has been a very volatile period with tons of geopolitical tension. How do you think about this when you come home from the other side of the world? Yeah,
so I've been spending an inordinate amount of time in China and Japan. I mean, China's kind of has some forms of disinflation, and Japan's actually coming out of deflation. On the China question, I think there are a couple of really important points to keep in mind. One is on the housing market, they do have excess homes, and that is putting disinflationary pressure on the economy. That's the fixed investment that drove the economy for years. That's kind of slowing. That will continue to slow. The offset of that is around industrial automation and the green trajectory, growth in that, the trajectory of the green economy. Those are booming, and they're actually disinflationary in nature, given that they're trying to export some of that. That is creating tension. One of the things, so I think some of that's in the market. What I would say is not in the market is people are missing what's going on around Asia in terms of Asian trade, including China. What you see is there's a huge boom, and that's leading to investment in transmission, logistics, data and infrastructure around that. So one of our big investment themes has been kind of this intra-Asia trade, and there are lots of ways to play that. China is not sitting around just depending on the U.S. for their exports. They're doing a lot more in Asia, particularly Southeast Asia, and that is leading to kind of I would say a virtuous cycle within the Asian region. You see it in the data right now. So they're going to look 5 years from now. They'll look a lot more like North America, Canada, Mexico, the U.S., as well as Europe and the kind of the regional hubs that they have there.
Henry, single best investment idea outside of China right now, given what you've seen outside the world?
I'm very bullish on what we're doing in private equity around corporate carve-outs. You've seen us do that. S&P Global in the U.S., VMware in the U.S., Hitachi in Japan. Those are even though rates are higher, those are great opportunities for our investors, and we're really pursuing those aggressively.